You are declined for $100,000 on Monday. By Tuesday morning, 3 more applications are out the door. That feels like momentum. It may actually be the fastest way to make the next no more expensive. Before you apply again, the rejection needs to become evidence.
Maybe the lender said your cash flow could not support the payment. Maybe the message only said that your application did not meet current criteria. Maybe you received nothing but a polite decline and a link to a help page. Whatever the wording, your mind may translate it into one sentence. My business is not fundable. That translation is often too broad. The real message may be that the amount was too large, the timing was too early, the documents did not tell a consistent story, or that provider was simply the wrong fit.
Welcome to Capital Conversations. I'm Glen Gould. Today, we are going to decode a funding rejection and turn it into a decision you can use. Not a promise of approval, not a trick for getting around underwriting, a disciplined way to find the actual constraint, fix what matters most, and decide whether your next move is to reapply, resize the request, change providers, pursue another form of capital, or wait.
To make this concrete, I want to use one fictional example throughout the conversation. Let's call her Maya. Maya owns a growing catering company. She has repeat customers, a strong reputation, and more orders than her current kitchen can comfortably handle. She applies for $100,000 to buy equipment, add staff, and cover the gap between paying suppliers and collecting from customers. The lender declines her.
Maya is disappointed, of course, but disappointment is not yet a strategy. Her first impulse is to send the same application to 5 online lenders. Before she does that, we ask a better question. What exactly did the lender see? Her revenue has grown, but it is seasonal. Her bank statements show large deposits, followed by tight weeks. She has $14,000 in monthly debt payments. Her books are 3 months behind. And her application says the money is for working capital, equipment, hiring, and marketing. Notice what happened there. Maya may have a good business. She may also have a difficult financing request. Those are not the same thing. A lender is not only asking whether customers like the company. The lender is asking whether this specific amount, for this specific purpose, with this specific repayment schedule, is supported by reliable evidence. Investors ask different questions, but they also need a coherent relationship between the capital, the plan, and the expected result. So preserve the decision before you try to solve it. Save the email, letter, portal message, and any notes from the conversation. Write down the date, product, amount requested, proposed term, stated use of funds, and documents submitted. If someone gave you verbal feedback, record the exact wording while you still remember it. Do not rely on the emotional summary you made 5 minutes later. The sentence may have been, "We cannot approve this product at this amount," and your memory may turn it into, "They do not believe in us." Those are very different facts.
Then ask for clarification without arguing with the decision. You can say, "Thank you for reviewing the application. I understand the decision may be final for this request. If you are able to share general feedback, which 1 or 2 factors most affected the outcome, and what improvement would make a future application more appropriate?" That is a professional question. You are not asking for confidential scoring rules. You are asking for direction and keeping the relationship intact.
The answer may be vague. Insufficient time in business may mean the provider needs a longer operating history. Cash flow does not support the request may mean the payment was too high relative to documented earnings. Credit profile could refer to personal credit, business credit, recent inquiries, utilization, payment history, or an error in the file. Treat the explanation as a clue, not a complete diagnosis.
I like to sort the possibilities into 4 simple buckets. Was this a fit problem, a timing problem, an application problem, or a readiness problem? You do not need to announce those categories to a lender. They are for your own thinking. A fit problem belongs to the match between your business and the provider's policy. A timing problem means the business may become eligible after more history, stronger recent results, or a temporary issue has passed. An application problem means the information was incomplete, inconsistent, or unclear.
A readiness problem means the underlying evidence does not yet support the amount or structure you requested.
Maya's rejection could contain more than one bucket. If the lender does not finance catering companies, that is fit. If the lender requires 2 full years of operating history and Maya has 18 months, that is timing. If her application lists 4 different uses for the money, that is an application problem. And if $14,000 of monthly obligations already consumes most of the cash her business reliably produces, that is a repayment capacity problem. The point is not to find one dramatic reason. The point is to find the constraint that changes the decision.
Now make a 1-page scorecard. 1 page. That is enough. Put the rejection wording on the left, your interpretation beside it, the evidence you have, and the next action. Track credit, cash flow, documentation, collateral, business history, provider fit, use of funds, and requested amount. Add a confidence level. High means the records clearly support your conclusion. Low means you are still guessing. That one distinction can stop you from spending 2 months fixing the wrong problem.
Start with credit, because credit is the category people usually blame first. Sometimes they are right. Sometimes they are looking in the wrong place. Review personal and business credit where applicable. Look for late payments, high revolving utilization, recent accounts, frequent inquiries, reporting errors, and inconsistent business identity information. Check that the legal name, address, and business details line up across registrations, banking relationships, invoices, and credit profiles.
If business credit is thin, that does not necessarily mean it is bad. It may mean the provider's model does not have enough history to evaluate you confidently. That is a different problem from repeated late payments. And if utilization is high, do not respond by opening 3 more accounts simply to create activity. Review balances, interest costs, reporting dates, and payment requirements. Make payments on time. Correct inaccuracies through the appropriate reporting process. Healthy credit is built through consistent behavior, not frantic movement.
But even a clean credit file cannot rescue a payment the business cannot carry. This is where cash flow becomes more important than the word revenue. Reconcile the bank statements. Separate business and personal activity where possible. Know average monthly revenue, gross margin, operating expenses, owner compensation, taxes, existing debt payments, and the cash remaining after those obligations. If revenue is rising but cash is tight, explain the reason. Growth can use cash through inventory, payroll, deposits, equipment, and unpaid invoices long before the income statement makes the pressure obvious.
Here is the question I would ask Maya. After every ordinary expense and existing payment, what amount can the business reliably devote to new financing during a slower month? Not the best month, not the month when every invoice arrives on time. A slower month. If the answer is $2,000, a proposed payment of $3,000 is not made safe by optimism. That is not a paperwork problem. That is a repayment problem.
Now, look for consistency. Your tax return, profit and loss statement, balance sheet, bank statements, bookkeeping system, and application should appear to describe the same company. Differences can be legitimate, but you need to explain them. If the application says revenue is $800,000, the statements show a different figure, and the use of funds changes from equipment to payroll to marketing, depending on who asks. The provider may see uncertainty, even if Maya's business is fundamentally sound.
This is where a clean document folder does real work. Keep formation documents, ownership information, licenses, recent bank statements, current financial statements, tax filings when requested, a debt schedule, major contracts, accounts receivable information, and a short explanation of the funding need. Label the files clearly. Use consistent dates. If there was a difficult period, do not hide it. Explain what happened, what changed, and what evidence shows the business now operates differently.
Maya might discover that her statements are not wrong. They are simply too old and too general. The lender cannot see that her biggest customers pay 30 days after delivery, or that her busiest season is approaching, or that the equipment would increase capacity with confirmed orders behind it. Current books and a clear explanation do not guarantee approval, but they make the business easier to understand. In funding, being understood is not everything. It matters a lot. The amount requested deserves its own test. Suppose Maya truly needs $100,000. What does the first $40,000 accomplish? Does it purchase the equipment that unlocks the next group of orders? Could a staged draw work? Could equipment financing address the equipment while a smaller working capital facility covers the collection gap? Could a line of credit fit better than a lump sum? The smartest request is not always the largest request. It is the request whose purpose and repayment path you can defend.
You might be thinking, but what if I genuinely need the full amount? Then prove the full amount in stages. Show what the first dollars accomplish, what the next draw unlocks, and how repayment changes at each step. If the full amount is necessary because of a large confirmed contract, document the contract, the timing, the margins, and the collection risk. Do not shrink the request just to make it look safer. Make the request more understandable.
Use of funds is often where that understanding begins. Working capital may be accurate, but it leaves a lot unsaid. Will the money purchase inventory tied to confirmed demand? Cover payroll during a receivable cycle? Add equipment that increases capacity? Refinance an obligation at a lower total cost? Fund a marketing test with a defined measurement plan? Connect the dollars to an operating result. Capital is easier to evaluate when the listener can picture what changes after the money arrives. Revenue patterns need the same care. Seasonal revenue is not the same as declining revenue. A project-based company is not the same as a subscription company. A temporary customer loss is not the same as a broken sales process. Gather monthly history. Explain seasonality, customer concentration, signed contracts, backlog, margins, and collection timing. If the business is genuinely declining, do not borrow to conceal that fact. First determine whether capital solves the constraint or only postpones it.
For Maya, the answer might be a smaller request tied to a specific piece of equipment, plus a documented plan for the seasonal receivables gap. Or it might be a pause while she catches up the books and reduces an expensive obligation. The right answer depends on the evidence. That is why a rejection decoder is more useful than a list of supposedly easy lenders. It helps you decide whether the next application is even the right next step.
Once you have the signals, prioritize them by approval impact. Ask 3 questions. How directly does this issue relate to the rejection? How quickly can I produce credible evidence of improvement? And does fixing it make the business safer whether or not anyone approves me? Correcting a minor file name problem may be easy, but it will not matter as much as reducing a major cash flow gap. Do not confuse activity with progress.
Here is how I would use the next 30 days. First, stop speculative applications. Second, preserve every decision and request clarification. Third, reconcile the books, review credit information, and list every current obligation and payment. Then, calculate conservative repayment capacity. At the end of those 30 days, ask yourself one question. Can I state the actual constraint in one sentence? For Maya, a useful answer might be, the business has demand, but the requested payment is too large for documented cash flow during the slow season. That is much more useful than, the lender did not like my company.
During days 31 through 60, move from diagnosis to evidence. Bring the books current. Improve collections. Reduce avoidable expenses where appropriate. Lower revolving balances through a sustainable plan. Close documentation gaps. Produce current financial statements. If the problem is the amount, model 2 or 3 scenarios: the payment, total cost, expected business result, and what happens if revenue arrives late. If the problem is provider fit, research providers before applying. Check eligibility, product structure, typical customer, industry policy, documentation, collateral, and personal guarantee requirements.
At day 60, stop and test the evidence. Is the issue actually improving? Are the numbers more current? Is the payment more supportable? Is the request clearer? If the answer is no, do not let the calendar pressure you into applying just because 2 months have passed. Time is not the same as progress. 90 days of waiting with no change is not a recovery plan.
By days 61 through 90, build the next decision. Prepare the short explanation. Here was the concern. Here is what changed. Here is the updated evidence. Here is the amount requested. Here is what the money will do. And here is how repayment fits within the operating plan. Then pre-screen the providers that match the business. Ask questions before submitting a full application when possible. At the 90-day gate, choose deliberately. Apply, resize, change the capital source, or wait.
Reapply to the original provider when the issue was temporary. The provider confirmed a realistic improvement path and the product still fits. Consider another lender when the original policy was the obstacle or another provider better understands your industry, stage, collateral position, or revenue pattern. Resize the request when the need is real but the first amount was not supported. Choose equity only when the growth plan, expected value creation, dilution, governance, and fundraising timeline genuinely fit an equity relationship.
And waiting is a legitimate capital strategy. If revenue is falling, taxes or existing obligations are unresolved, the proposed payment would leave no cushion, or you cannot explain how the funds create a return, a pause may protect the business. Waiting can mean strengthening margins, building reserves, collecting receivables, improving reporting, testing demand, and reducing uncertainty. Capital should expand a sound plan more often than it should compensate for the absence of one.
Now, the danger after a rejection is emotional borrowing. You hear no, urgency rises, and the first expensive product starts to look like rescue. The payment may be daily or weekly. The total repayment may be hard to calculate. There may be fees, a personal guarantee, a blanket lien, default provisions, prepayment restrictions, or a renewal structure that keeps the balance moving. Alternative products are not automatically inappropriate, but you need to understand the entire agreement before you decide.
Before accepting an offer, compare total dollars repaid, effective cost, payment frequency, payment trigger, term, fees, collateral, guarantees, and default consequences. Ask what happens in a slow month. Ask whether the payment comes before payroll, taxes, inventory, and essential operating costs. If the deal only works when every forecast is perfect, it may not be resilient. And if you cannot explain the structure to a trusted advisor or an appropriate financial professional, pause before signing.
Be thoughtful about application timing too. Depending on the product and provider, repeated applications can create hard inquiries or multiple underwriting reviews. Even when they do not, a string of applications can create inconsistent information and make it harder to learn what is limiting approval. Research first, prepare once, apply where the criteria fit. Keep a record of what you submit, so the next conversation begins with accuracy instead of confusion.
Let me answer the question many founders are carrying. How do I know whether to keep trying? Try again when you can explain the previous decline, address the highest impact issue, document the change, and identify a provider whose requirements fit. Do not try again simply because the rejection feels unbearable. That is a feeling, not evidence. Your next application should be the result of a better decision, not an attempt to escape the last one.
Maya's story could now end in several responsible ways. She might obtain equipment financing for the specific asset and use a smaller line for receivables. She might return to the first lender after updating the books and reducing the request. She might find that the seasonal cash gap is too risky right now and wait. None of those outcomes is a failure. The failure would be accepting a structure she cannot support simply because the first answer hurt. Before your next application, use this compact decoder. Save the decision. Ask what affected the outcome. Sort the signal into fit, timing, application, or readiness. Verify credit and business identity information. Reconcile financial statements and bank activity. List every debt and payment. Define exactly what the money will do. Calculate conservative repayment capacity. Test a smaller amount or different structure. Pre-screen the provider. Then compare the complete cost and downside before accepting anything.
The deeper lesson is not that every rejection contains a hidden approval. It does not. Some decisions reflect policies outside your control. Some feedback is incomplete. Some businesses need to change before more capital makes sense. The lesson is that a rejection can improve your next decision if you document it, question it professionally, test it against your records, and act on the constraint with the greatest impact. So if a rejection is sitting in your inbox, do not erase it, and do not let it define you. Put it on one page. Write down what happened, what you know, what you are still guessing, and what evidence would change your mind. Give yourself 30 days to establish the facts, 60 days to produce improvement, and 90 days to make a deliberate capital decision. The goal is not simply to get approved. The goal is to secure capital the business can use productively and repay responsibly.
Before you open another application, spend 10 minutes with the Decoder. Write down the rejection reason, identify the constraint, choose the highest impact fix, decide what evidence would make you wait. If this episode helped you think more clearly about funding, subscribe to Capital Conversations for practical conversations about business credit, loans, investment strategy, and entrepreneurial growth. We will keep turning capital questions into decisions you can actually use. Keep building. Until our next conversation.
Thank you for joining us on Capital Conversations. I hope today's discussion provided valuable insights for your funding journey. Remember, securing the right capital is a crucial step in building a successful business.